Hello and welcome to this weekly market recap for Thursday, September 26th. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it is a pleasure to be back here with you all. I did miss last week because of a vacation. I do take those once in a while, but it is great to be back, taking a look at the market, and got a few things I want to share with you today. One thing I do want to say is that the Fed did meet last week. Tuesday and Wednesday of last week, we had the policy decision finally to cut interest rates. The Fed took a bold step and cut by 50 basis points. I was thinking it would be more like 25 basis points. I think the market expected 25 basis points. And the initial reaction on Wednesday afternoon, we saw a jump to the upside, and then we came back down, closed pretty weak. But then on Thursday morning, everybody kind of gathered themselves. We saw a pretty big gap up at the open. And we've seen some buying since, but I'll show you a chart that shows that there hasn't been a whole lot of follow through just yet, but we'll see how we close out today. But let's go ahead and get started. Take a look at the charts. The first chart I want to show you, the Dow Jones Industrial Average. So we'll start here. You can see the Dow now has made it up over 42,000, currently trading. Let me give you an update. Yeah, 42,165. So we are in record high territory again, looking to close at another record high. So it's really difficult to get overly bearish the market when we're seeing some of the major indices setting all-time highs. And that's certainly the case right now with the Dow Jones. What I've done here is since the last time I did one of these updates, is I removed the negative divergences. And that's because the PPO is starting to rise again. And as we put in higher highs and higher lows, we're also doing the same thing now with the PPO over the course of the past maybe month and a half, 2 months or so. So I think the momentum is actually starting to build again. Now, by definition, you could still draw a line here and say that the highs are lower and that the PPO highs are lower and that the price action is actually higher. So by definition, it's a negative divergence. But when I see this PPO start to go up with multiple highs, it's kind of hard for me to really get on board with that slowing momentum argument. Looks to me like momentum is starting to pick up. Notice these 4 arrows. This is where we've seen the Dow Jones continually rebound off that 20-week EMA, and that's a bullish sign. As long as we can continue to do that, I think the Dow's in pretty good shape. If we lose the 20-week, we'll have a different discussion, but for now, I think this looks pretty bullish. Next up, S&P 500. We had that top back at the beginning of 2022. So to me, that is like the big support still to the downside. I'm not saying we're going there. I'm just saying that's the big support level down a little bit over 4,800. Then we had the April low that came in about 49 and change up near the 5,000 level. And the S&P on this weekly chart does still show a negative divergence. We have prices continuing to go up, and we've got the PPO continuing to go down. Those highs continue to drop. So that tells me that the 50-week moving average is still potentially in play. Potentially. We don't always go down there. But normally when I see a negative divergence, I look for a pullback in price to the 50-day and or the PPO dropping back down to the center line in order to get a reset where I think the market can then start to move up without negative implications from negative divergences and so forth. So anyway, that's where I see the S&P 500 at right now. Again, breaking out to all-time highs. It's really hard to get overly bearish when you're seeing these all-time highs, but still got to, negotiate, excuse me, what could be a potentially volatile month of October. We'll talk about that a little bit more this weekend. I've got an event coming up, and I'll talk to you about that in just a bit. But let's move on first to the NASDAQ 100. So the NASDAQ has not yet hit that all-time high, but you can see with today's high, we were up pretty close to that level. So this is a group, this is an index that's been lagging on a relative basis after leading the market much of this secular bull market advance since 2013 and through the month of July of this year. But since then, we've seen this relative weakness come in. And so even though the absolute price action has been going up, we still have relative weakness in the NASDAQ 100. And that could be a problem as we try to negotiate higher at the end of September and into October. So I would say the Dow looks pretty good. The S&P 500 is good, but there's a little caution. Then we look at the Nasdaq 100, and I would say this one is more cautious than the others because we've yet to get that breakout. We could simply be looking at a double top, and maybe further sideways consolidation. Russell 2000, I think, also kind of like the Nasdaq 100, it's been rallying, but it hasn't been able to get above its recent high. Still see a little bit of weakness here that I think we need to at least be aware of. Relative weakness I'm talking about that we need to be aware of. But one thing I've drawn here are 3 green arrows where we've bounced off that rising 20-week moving average and then went on back up, and in the case of July, put in a new high. We've been threatening to get back through that high, but haven't done it yet. It would be bullish if we can make that breakout above about the 225 level. That's what I'm looking at on the IWM. Meanwhile, you can see some support areas going back to where previous tops were and also where we saw some previous lows, like back in January of 2024. So that's kind of the range that I would look at right now on the IWM. Now, I think a few weeks ago, I looked at the S&P 500 under multiple time frames. I want to do that again since it's been a little while since we did that. Here's the monthly chart. I think the monthly chart on the S&P 500 looks awesome. And you have to understand, though, that you can take on some weakness on a monthly chart and it doesn't show up, that soon. Right now, we're trending above the 20-month moving average. We could always test that at some point, and that's down just below 5,000. So again, that price support level that I gave you on the S&P 500, a little over 4,800, a test of that ultimately would be nothing more than a test of key support and the 20-month moving average. So I think on the daily or the monthly chart, I think we're still looking pretty good here. Weekly chart, again, we've got that negative divergence, higher prices. I got that pink arrow in there to mark where that 50-week moving average was back at the beginning of September. But you can see that's been continuing to rise. That currently comes in at 5105. So maybe a little bit higher low based on the weekly chart. And I'm talking about if we were to see, what I would consider to be maybe worst case scenario. And I know some would argue and say, well, we could have a recession, we could have a big drop. Possibly. I'm not seeing it, though. Based on what I'm looking at, these are kind of the lows that I would, maybe consider. Looking at the daily chart on the S&P, you can kind of see we got this breakout. We gapped up this morning again, pulled back a little bit earlier. So we are kind of well off the earlier highs today, but we are holding the breakout level so far. If we fail to hold the breakout level, you've got that 20-day moving average, and then you've got the 50, and then, of course, you've got early September low that we saw when we opened the month off in pretty weak fashion. So those are some levels to look at to the downside. I really love the market long term. I mean, I can't overstate this because I spend a lot of time talking about short-term cautiousness, short-term historical tendencies, and that sort of thing. But I want everyone to understand when you've got interest rates dropping in a positive GDP environment, the valuations of the stock market, individual stocks, should go higher. Obviously, that's going to depend a lot on what the individual stocks are doing. But with ignoring everything else, just talking about interest rates, when rates come down, valuations go up. Now, you might say, well, sometimes rates come down, the market goes down. Well, that's because the economy is slowing and the rates are coming down to fight a slowing economy, to try and turn things around. In this case, the Fed is saying, okay, inflation, we believe we've beaten inflation and we're kind of getting ahead of the curve and as far as possibly a weakening economy. And so if they get that soft landing without a recession and inflation done, that's nirvana for stocks. So keep all that in mind. Last one I want to show you here is the S&P 500 hourly chart, where we got the gap up, we've pulled back, trying to bounce back off of it. I see a couple of key areas. We had a gap up from back on September 18th, down around the 5620 area. And then also after gapping up the low, that subsequent low went in at about 5675. So that's where I see the short term based on the hourly chart. Now, I do want to just tell you a couple of things about the history of the market. So I just want to tell you that the worst week in the month of September is from the 19th to the 26th, 19th close to the 26th close. And it's also the second worst week of the year, of the calendar year. And so just to give you a couple of numbers, since 1950, this 1 week period has gone up 26 different times and it's gone down 48 different times. And if we only look at the turn of the century, we've seen it go up 5 times and go down 19 times. And of course, this is not including the current period, which, by the way, ends at today's close. Now, if you look at where we were on the 19th, here is the 19th. Here's where we closed on the 19th. We closed at 57.1321. Now, we went down initially on the 20th, and then have rallied back. We opened up today pretty good, but now we're coming back down, and right now we're sitting at 57.39 versus the close of 57.13. So that's only 26 points. That is less than 0.5% that we're up right now. And we don't know where we're finishing today. By the end of the day, if we do see a sell-off, and maybe this is some sort of a topping candle with the gap up, maybe a bearish engulfing, or maybe we go back higher. I don't know. My point is, we still could have this period be lower, even though we've seen mostly a rise throughout the entire period. So just kind of keep that in mind. We may extend this to, only 5 gains in the last 25 years if we have a rough finish today. Otherwise, it would be 6 out of 25. Still, again, when we talk about these trends, they're not guarantees. They're simply trends. They're simply giving you tendencies. So don't treat them as though this is the primary indicator on whether the stock market's going to go higher or lower. This is clearly a secondary indicator, but it's a tendency to be aware of. It's kind of like when the RSI hits 70 or 80. The tendency is that market's overbought and it's going to pull back, but it doesn't always do that. Kind of treat the historical information I give you in the same light. Anyhow, I'm going to be discussing a lot about September weakness, also how the month of October and throughout the fourth quarter, how all of this, how we typically perform. So we've got a sign up form. This is what it looks like. If you want to come to this event on Saturday morning at 10 a.m., all you need is a name and an email address, or all we need is your name and an email address. Hit that register. One thing we will give you is a bonus PDF, 74 years worth of market bottoms. I'm going to give you a lot of tendencies about the fourth quarter and how the fourth quarter normally operates. I think this will be great educational information for you to take forward. It's not just about this year, it's about every year, and knowing and having a bit more information about how you can use this information to your benefit. So now you see a slide up on your screen. I mean, I've been studying the market bottoms for the past 74 years. That goes back to 1950. And I've made some key discoveries that could impact your trades as we go forward. So you need to understand this history to get a glimpse of what might lie ahead in October and throughout the fourth quarter. So you can register for the event as I showed you the form for this Saturday at 10 a.m. That's September 27th. And you'll receive entry into the webinar plus a free bonus ebook that I just showed you. So that's available for download as soon as you register. You can find the registration link in the description in this video, and simply enter your email address to register. No credit card required, and I'll see you on Saturday. But at the bottom, there's a little area where if you're on your mobile device, you can scan lower right side. You can scan that and go right in and register. We'd love to have you, and I really do hope to see you on Saturday. All right, I got a couple more things I want to show you as we get going toward the close of this particular session. And I want to look at relative strength. So I'm going to look at it from a sector perspective, and then I'm going to look at it from an individual industry group perspective. So if you look today at what's happening today, and let me get an update just to make sure we got the latest here. Right now, we've got materials having a really good day. Materials have been strong. We've seen a breakout on an absolute basis. They're showing great strength on a relative basis right now. So materials have been very, very strong, which I think's great. I mean, it's a little bit more out of character for a market that's trying to set new highs. Normally, we see the more aggressive areas like technology, industrials, financials, consumer discretionary and communication services. But notice those five are in the area, are in the number 2 to number 6 slots. So they're doing their part as well. Any of these groups that you see out here, this is their percentage change relative to the S&P 500. So it's not necessarily, I'm not saying materials are up 1.78% today because the S&P 500 is up. They're actually up more than that because they're up 1.78% more than the S&P 500 today. So just keep in mind that these are relative numbers that we're talking about. Energy, which has been struggling, crude oil prices could not get through resistance at $72 a barrel. When that rolled over and started moving back down below the $70 a barrel mark, that's when we saw energy also struggling as well. So a lot of this isn't rocket science, but at the same time, when you look at this, you see 6 groups up, 5 groups down. That's a bifurcated market, not really showing us a great day. We like to see wide participation in everything, but the aggressive groups are at least among the leaders today. So the action so far is good, but you might want to take a snapshot at this and look again at 4 o'clock, because if the market does pull back into the close, I'd be interested to see how this relative strength shifts in the afternoon session today. So anyway, you can check that out. I also wanted to look at the industry groups. And here is what's going on today. Here's the aluminum group, non-ferrous metals. Those are 2 big groups in the material space. And you can see the relative strength there is incredibly strong. Also, if you just kind of glance down, each one of these industry groups, I have the sector that they're in. It's illustrated by the sector symbol. So the XLB is materials. Then you've got XLI, which is industrials. So you can kind of see what areas are being impacted the most to the upside today. And then if you flip this and go down to the percentage change to the downside today, you can see that energy, you got 3 energy groups leading to the downside, which makes sense because energy is leading to the downside today among sectors. But the other thing you can do with these chart lists, the way I have them set up, is you can take a look back, say, over the last week. What's been weak on a relative basis? Well, still some energy. We've got healthcare, discretionary. We've got home builders in this group over the last week. That's been a very, very poor group. But then we can go all the way back to June. Remember, many of the technology areas of the market struggled back starting in June, including semiconductors. And on this list right here, you can see semiconductors is the 10th name. The first name, transportation services, not followed. That industry group isn't followed any longer, so we can ignore that. But the next 10, the 10th one on the list is semiconductors. 9th one is internet stocks. So we've got some key growth industry groups that have not performed well since June. And that is what makes me a little nervous, a little bit more cautious about the market, because we're still struggling in some key areas. We're not getting breakouts in those areas like we saw in the Dow and the S&P and even the Nasdaq trying to break out. If you look at the semiconductor group, we still have some work to do to get a breakout. We still got many of those semiconductor names that are way down below their highs that they set back June or July earlier this year. So it's not a perfect market out there. I do really like the market going forward, and I'm talking about into year end and into 2025. But September tends to be volatile. We've had a pretty good September so far. Still got the month of October, which we know there have been some pretty serious drops in October over the years. And some of the rotation is still questionable, I would say. But from a longer term perspective, I look a lot at sentiment. I look at a lot at the long-term relative strength, and I still believe the long-term is set up beautifully for the market. I think we go higher, but we do still need to kind of negotiate this patch maybe for the next few weeks. Anyway, if you want to follow me on, at EarningsBeats, we got another slide up for you. You can simply scan on your mobile device, scan that QR code, and it'll take you to a page where you can learn more about following us and following me various social media and so forth. All right, that is it though. For me, I'm again glad to be back after a week off. Was able to recharge the batteries for a few days, which was really nice. Always nice to get away for a bit, and then come back kind of fresh and take a look at the market. I'm impressed with what the market has done in September. September has gone down 41 times in the last 74 years, and it's only gone up 33 times. It's the only month that's gone down more than it's gone up. So anytime we see the market battling through some, some difficulties during September and showing higher prices than where it was at the beginning of September, that tends to be a bullish thing. So I see a mixed market right now in the near term. I wish I had something that was a little clearer on which way we're going to go near term, but I do really like the market once we get through this next month or so. Anyhow, that's it. I really appreciate you tuning in. Be sure to like the video, subscribe to the Stockcharts channel, and like I said, follow me in those various areas on the page that you were directed to. Have a great week, everybody. I'll be back next week to do this all again. Happy trading.